Good evening, everybody, and welcome to ATFX. My name is Philip, and I have the pleasure and honor of being your presenter for today's webinar. Today, we want to focus on Fibonacci levels. How can we use Fibonacci levels without too much boring theory, just focusing on the markets and seeing how we can apply those Fib tools. And yeah, ultimately, how can those Fib tools help us to make money in the markets? Just as always, if you have a look at your webinar interface, you see that small questions box. And right now, I would appreciate a very short yes or why in that box to just let me know that you guys can hear me well. The first feedback is already here. Vincenzo, you've been the first one. Thank you very much for that one. And all right, we seem to be good. And yeah, please, you're not interrupting my flow. I want you guys to ask me questions because I feel asking questions really is a vital part of the learning experience. And for that very reason, please, if something is not clear, let me know. I do my very best to answer your questions as we move through the webinar. Today's webinar is scheduled to run for around about an hour. And of course, before we get started, you already see those first risk disclaimers here on the screen. I have to make you aware of those. So please take a moment of your time to read through them carefully and make sure that you're comfortable with them. Essentially, this says that trading, of course, involves risk. And you should understand those risks and the instruments you're using before you're getting active in the market. As neither ATFX nor Trade with Position nor myself are registered investment advisors, nothing that we say should therefore be considered to be actual investment advice. All examples are shown for educational purposes only, especially true for the live part of today's webinar. We will be doing this complete webinar on the MetaTrader 4 platform. We will be looking at live market data. I can just tell you what I see on those charts. It's never a trade recommendation. The idea here is I want to give you guys the opportunity to look inside my head. What is it that I see on those charts? How do I use those tools? And how ultimately I do arrive at my trading decisions. Now, I have losing trades. Let's be perfectly clear about that. I don't have a crystal ball. Just today in the morning, I saw a beautiful setup. I traded that setup. Guess what? I have been stopped out just to see the market a few hours later to perfectly play along with what I saw, what I had seen there. It happens to all of us. This is not how we make money in the markets. This is not about the next one trade. Trading is all about probabilities. And therefore, it's never, I know what's going to happen. No, I can make an educated guess. And hopefully this educated guess will be right more often than not. And if I'm right, I also want to make more money than I will lose on my losing trades. And this is how we make money. We're looking for, in order to have a positive expectancy, more winning trades than losing trades, and the winners should be bigger. Never, ever focus on the next trade. The next trade means nothing. Can be a winning trade, can be a losing trade, and there's nothing that we can do about it. We have to focus about a large sample set of trades. So coming back to the risk disclaimer, even though I might say I see a certain setup or something is developing here, it's just my view. It's just my opinion. In the end, a random guy on the internet telling you that he likes a certain market or not should never, ever be good enough for you to put your money on the line. You must have your own trading strategy. You must arrive at that idea and conclusion why you want to open that trade in that position in the first place. So everything that we do here is really just for educational purpose. So please make sure you're okay with this before continuing with the session. And that being said, let's have a look at today's agenda. Let me quickly scroll up here to see that I'm up to date with the question. Guys, thank you very much, everybody here for the kind feedback on the audio and visual check here. All right, today's agenda: how to correctly draw a Fib retracement on a price chart. Sounds rather easy. Guess what? You can do it wrong. So, what is the perfect context for us to use that tool? First thing that we must make clear, because if it's a nail problem, I need a hammer. The most perfect screwdriver in the world won't help me. And that's the same thing here with my technical analysis techniques that I can use. I must have the proper context. It must be the right task for the right analysis technique that I intend to use. All right, so Fibonacci mistakes that can lead to misleading signals, how to set up the MetaTrader 4 Fib tool as per your personal requirements. Let me just All right, here we are. How to turn Fibonacci signals into potential trading opportunities. We want to build a case. This is just one tool. It doesn't make sense to just focus on one tool and assume that this one tool is the best tool ever. It's just like a surgeon. If the surgeon has a beautiful scalpel in order to make those precision cuts, if that's his only tool, he won't get very far. Same thing here. I must use Fib in the right context and combined with other tools and techniques to help me make a case for potential trading opportunity. All of this is done here today on the MetaTrader 4 platform. We'll be doing this live in the markets together, so no further slides. Just towards the end, why, if you haven't opened that account yet, why should you consider ATFX to be your broker moving forward with your trading career? So, trading with Fibonacci levels. And now let's just directly switch over to the markets. All right, so here we are. One thing that we must make sure to understand is it doesn't matter what the market is. It doesn't matter what the time frame is. The type of trading that we do on those charts is always done purely based on price action. So I don't care if this is now the S&P 500 or if this was a Forex pair or if this was a commodity or treasuries, or I don't care. It doesn't matter. It doesn't matter at all because what we're seeing here on this chart is just price action. My professors back at university always told me, Philip, there's no merit in looking at charts because price is completely random. I absolutely do not agree, because what we see here on that chart is not just price. Price is the observable result. But why is price where it is? Because people acted in the markets. People traded upon certain price levels, upon certain information that they had, and price is just the observable result that we can see on the charts. And therefore, I feel that there's a lot of merit to look at charts and try to understand what we see here just by reading price action. And all analysis techniques that we use in our charts, they are redundant. Because if you think about it, we are using here our moving averages, 10, 20, 50, 200. What goes into the calculation of those moving averages? Well, it's just price. So what those moving averages do is they transform the input to give us another output, but they can only process what has been given to them. It's just like a chef in the kitchen. If you give him only eggs, he can only make something out of eggs. He can't make any cheese dish, he can't make any vegetable dish out of it. It's just, he can just transform what he has been given. Same thing here with my technical indicators. They can just transform information. They can make it easier for me to see certain aspects of price behavior, of price action, but they cannot create new information. That's a really vital part. There is not that one magical indicator that gives us true vision. No, price action. Only price is the real thing. So why do we have those indicators here in our charts? Because they help me to visualize things easier, faster, and they make it easier for me to scan a lot of different markets quite efficiently. For example, looking at the structure of my moving averages here, I just know that this is an uptrend. Sure enough, I can look at the highs and can see that the market's making higher highs and higher lows. And I arrive at the same conclusion that this is an uptrend. However, just looking at the moving averages here, okay, has to be an uptrend, has to be an uptrend, probably is a downtrend during those stages. Same thing here with MACD. Everything that MACD and RSI are telling me are just is redundant. I can see the same thing here just looking at price action. It takes a little bit more experience, it takes a little bit longer, but they can't create new information. Very crucial thing to keep in mind. So let's talk about Fib extensions. Vincenzo has been asking about Fib extensions. I'll try to sneak in some Fib extensions as well. Main focus here for today should be about Fib retracements, however. What are Fib retracements? Well, the idea is, and I don't want to give you guys too much theory here. who of you hasn't heard at all about the Fibonacci sequence and how those Fib retracements and the Fib numbers and ratios actually are being calculated? Just give me a quick idea. Where are you? No idea, never heard of them. That's perfectly fine. So let's quickly cover those. The Fibonacci sequence is just, it's very simple. You start with the number 0 and with the number 1. And then the next element in the sequence is just the number, it's just the sum of the previous two numbers. So 0 plus 1 equals 1. So the third element is 1. 1 plus 1 equals 2. 2 plus 1 equals 3. 3 plus 2 equals 5. 3 plus 5 equals 8, and so on. And this is the Fibonacci sequence, simple as that. And the guy who came up with this, Italy, the son of Fibonacci, well, sorry, my Italian's quite bad. It's just, yeah, that's his name. He's the son of help me there. Fibo means son, and he's the son of this guy. I think he was called Nachi. However, that being said, he was a mathematician, and he stumbled upon this series of numbers when he tried to analyze the growth rate of a population of rabbits. Thank you very much, Vincenzo. I was hoping that you could step in here. Phi is short for son, and so it's the son of Bonacci. Thank you very much for helping me out here. Perfect. So the son of Bonacci, he studied the population of rabbits and rabbit growth. And this is where he stumbled across this sequence. And the funny thing is that this sequence has some specific attributes, some specific properties. And for example, if you take, if you divide one element of that sequence by the previous element of the sequence, this ratio will start to move towards the golden ratio. So if you divide 8 by 5, this is almost equal to if you divide 13 by 8 or 21 by 13 and so on. And this converges pretty fast and pretty quickly towards the golden ratio of 1.618. And many more factors here. The funny thing is you find those things, you find this golden ratio pretty much all across the place. You find it in nature, you find it in the shape of sunflowers, you find it in the spiral arms of the universe, you find it in the Nautilus shell, you find it in cauliflower and broccoli, and you find it everywhere. It's everywhere. This is just some natural harmony, let's put it that way. And the nice thing is, while all this is nice and dandy and is always good for some kind of cocktail party, the nice thing is it helps us tremendously as traders. And so let's focus on how we can use those Fib retracements here and those Fib ratios here as traders. So what we can see here on this chart, and the first thing that we have to be aware of is that I can only make use of those Fib retracements in the context of a trend. If the market is moving sideways, it doesn't make much sense to put those Fib retracements there. However, once I have a trending environment, then I can start to use those Fib retracements. Where can I find those Fib retracements here on the MetaTrader 4 platform? Well, you look here in the toolbar, you have this small f, draw Fibonacci retracements, and you just click on those. And now you can draw your Fib retracements in. And you can just start to draw from a swing point high. I still have pressed my left mouse button and I only let it go at the swing point low. Now, why from here to there? Because in this downtrend, this is the most recent swing point high. Remember, a downtrend is defined by giving us lower highs and lower lows. And sure enough, I have lower highs and I do have lower lows. So price is making a lower high price is making a lower low, and so from the most recent swing point high to the most recent swing point low. Darren is telling us that he can't hear anything, so just a quick sound check again, guys, but I'm pretty sure, Darren, that this has to be on your end. Okay, sound is fine. All right, guys, yeah, okay, let's carry on. Perfect, guys. Thank you very much for the quick feedback here. So a swing point high to a swing point low in a downtrend, and this is how we draw our Fib retracements. We always pick the most recent swing point and draw it to the current swing point high to swing point low. And what we can see here now is that we do have several Fib retracements. We have the 23.6. I'm not that much interested in 23.6. The Holy Trinity, if you forgive that pun, for me is the 38.2, 50, and 61.8. So why those three? Well, price never really moves in one straight line. Price never goes from here to the bottom and never looks back. It's always this idea, this pattern of 2 steps forward, 1 step back, or in a downtrend, 2 steps down, 1 step back up. It's always this push-pull. It's always this cycle, this rhythm. And so if price has moved for quite some time, price is exhausted. There's some kind of exhaustion going on, and price has to stop and catch its breath. And this catching its breath is when price is about to retrace. And what we have identified is that price often retraces in a manner that is in line with those Fib retracements. We use multiple tools to help us spot areas where price might have pulled back enough and is now ready to gain more energy to continue in the direction of the trend. One of those tools are our moving averages. We look at the 10 and 20 period moving average. They form in a downtrend or a moving average sell zone. And we like to call this price equilibrium levels. Another way, and this is what we want to focus on here today, however, is the sweet spot for a pullback, considering Fib retracements. And if we look that price is pulling back towards the 50% and 61.8% retracement level, this is the sweet spot from a Fib retracement level area. So does this mean price will always retrace after a move 50 to 61.8%? Absolutely not. This is not how technical analysis works. It's never about price has to do something. It's always, it's likely that it happens. And likely doesn't mean 95%. Likely can be 51% that it happens and 49% that it doesn't happen. The idea with technical analysis is if I can identify multiple such a little bit more likelies than not, I can start to add those on top of each other. And suddenly I can arrive at a probability that this trade happens to work 60 times out of 100 trades. Or maybe even 70 times out of 100 trades. I will still have 40 or 30 losing trades or even more. But the idea is I want to win those setups more often than not. So everything that we do here is trying to help us stack those odds, stack those probabilities in our favor. And so the sweet spot for a pullback is 50 to 61.8. So where does the 38.2% retracement come into play? Well, what I can do now is I can start to stack my Fib retracements on top of each other. So if that's the recent swing point high to the current swing point low, what I can do is I can draw another Fib retracement from the previous swing point high to the same swing point low. And I really do have a beef here with the way that MetaTrader 4 is plotting those, because obviously he starts to write on top of each other. But what we can see here is that price is giving me now a 38.2% retracement from this higher order or higher time frame, if you would like to think about it like that. Higher time frame move, 38.2, and this sits almost perfectly on top of the 50% retracement from the from the most recent move. Does this make sense how I go about and look for those clusters, guys? I'm looking for areas where there's a lot of probability, and you can think of those lines at those levels. I like to think of them as some kind of magnets. They pull price. Does this mean price always has to go there? No, absolutely not. But there's a certain pull. Why those levels are there? I just feel that people think that this is once again harmonic. It's price has pulled back. Yeah, price has pulled now back a decent amount, and now it's judgment time to decide where price might be going next. Does this mean price will continue in the move of the trend? I don't know. Nobody knows at that stage. But first idea, this pullback might be over here. In this example, yeah, price pulled back, price continued a little bit more, however, then the trend changed. So would this have given us here a perfect buying or selling opportunity? No, it didn't. And I specifically picked this example to show you guys there is no perfect tool, but I hope you can see that price really pulled back towards this area. And let's try to make it a little bit larger here. Look at the structure and size of those candles. Obvious strong downtrend, huge bullish counter move. A candle can't get more bullish than that. Next move higher, again a bullish candle. But I hope you can see that this candle already is smaller than the previous one, and the high that this candle started to make is also, it's a higher high, but it's not as much a higher high as the previous one. We can start to see that this price already starts to put a little bit of arch in here. Does this make sense? Just looking at price action, just reading price action, just seeing how bulls had a harder time from each candle to see that price is about to push higher. All this coming together here almost perfectly at this cluster of the 38.2% retracement and the 50% retracement. Just looking at the questions, but we seem to be good. So one important thing to take away here is this a lagging indicator? Many people like to trade based off when moving averages cross each other. But if you think about it, here we have the cross. The 10 is crossing above the 20. Guess what? It would have been so nice to buy this market back here or back there. If we bought this market here, yeah, we're pretty late to the party. Lagging indicators. What I like to do is I want to see leading indicators. I want to have an idea about what the market might be doing next. I will never know for sure, but just a little bit more likely is good enough for me. And the nice thing is, I think that I know that this might be the swing point low. Why? Because price is obviously rallying so strongly. Now, I am able to draw my Fib retracements the very moment where I think that this candle is about to finish in bullish territory, and this might have put in here some kind of new swing point low. And from this point onward, it's a leading indicator, because here with this candle, and by the way, we're looking at a daily chart of the S&P 500, but once again, could be any market, could be any time frame. From this point onward in time, I knew that this price level here had a certain probability, a certain attractiveness, a certain kind of pull to market price. Could have stopped before, could have moved forward, but I feel that this area here just felt a little bit more likely. How to trade this market? Well, completely comes down to your style of trading. If you think you want to be a counter trend trader, this market here is in a downtrend. However, we are definitely overextended here at those price levels. There has to be some kind of snapback, and sure enough, that snapback took us right to this sweet spot from a Fib perspective, and also to a sweet spot from our moving average sell zone. Price has pulled back to the moving average sell zone, and there it seems the price might be starting to continue in the original direction of the trend. So if you want to be a counter trend trader, at any point here, you could have initiated your pullback trade with this being a very likely, a very probable target. No guarantees. You always want to have proper risk management in place, proper position sizing, because we just don't know if this trade is going to work out or not. And if I don't know if that next trade will be a winner, I must assume that it will be a loser. And therefore, I must have a constant risk exposure on my trades. It doesn't make sense to have 9 winning trades and 1 bad trade wipes out all the gains of the previous 9 winners and then some more. Vincenzo is asking here, is just mentioning that apart from the usual moving average types, the simple or exponential, and by the way, it doesn't matter if you go for simple or exponential here, that there are other variations of moving averages which are quite fast to react. One of these examples here would be Hull. Perfectly fine, absolutely there with you. And again, it just depends on what kind of trading do you want to do and what kind of tools do you want to have in your on your tool belt, to put it that way. Lorenzo is asking, can you apply it in any time period from 1 hour to daily as you show? Absolutely. It's just the same thing all over again. So let's just get rid of those. And by the way, how can I get rid of those? I just try to double click here on this red line, and then you can see very faintly that it becomes selected, and I can just hit my delete key and remove it. What I can do, and let's just be crazy here and zoom out very, very deep. Now, what could be potential targets for pullbacks? And when the market started to move and moved big time here in the S&P 500, it's still a daily chart, it's just zoomed out big time. What I can do and what I started to do there for this, will the market break down? Well, let's take the swing point low, go to the swing point high, and see where potential targets are. 50% pullback right here, there, 61.8% pullback right sitting there. Let's go for another one. Let's go from this swing point low, for example, to the very same swing point high. And you start to see here once again that this area here where price after the first steep sell-off started, and let's start to zoom in again. I hope you can start to see that price actually stopped here at this first cluster setting up. So it definitely works on much larger time scales and time frames, but it also works on the smallest ones. We use the same set of analysis techniques on all our charts, on all our time frames. We always look at the 10, 20, 50, 200, and we always look at Fib retracements independent if we look at a monthly chart, a weekly, daily, or even an hourly chart. So let's have a look, for example, let's go to the US dollar against the Swiss franc. And the market has started to push higher a little bit here. We're still in that range, in that zone, but let's drop down now to a 15-minute chart. Let's just see what's going on there. I hope you can see that the lower time frames have more noise, less signal, more noise, which is why I personally like to trade on the higher time frames. I don't have to have this idea of 1-minute charts. And why? Personally, I do not suggest that those are not great time frames to trade. I just want to explain what I personally don't like to trade them. I have to be obviously quite fast here because my position sizing, where is my stop loss, where's my entry, all this, I have to do this very, very quickly. Because within 1 minute, this candle is done and the next candle will start. I want to take my time. I want to double and triple check my position sizing calculations and so on. And this is why I prefer to trade on an hourly chart, 4-hour chart, maybe a 15-minute chart or a half-an-hour chart. The trade today was on the half-hour chart, but this is really just my personal style, and cup of tea. Now, the question is, how could I use this? If I think that this candle structure here is bullish, and once again, I do not suggest that this is a great trade or trend or usage of that technique here right now, but just in the here and now right side of the chart, how would I use this potential downtrend here to identify a potential pullback target? Well, what I could use is my Fib retracement from this swing point high to this swing point low. Where would price be pulling back to? Well, 50, 61.8. So obviously this might be an area for potential pullback here. What I can also like to do is I can use my horizontal levels of support and resistance. And what I can see here, that this area of support resistance, touch here, another touch there, another one there. This line, this stupid, simple horizontal line is another leading indicator, because I can put it on my chart, and let's try to make this line a little bit thicker and larger. Properties. No, sorry. Let's go. For this one here. I see the first touch. I see that price reacted to this level here before. Second touch here, third touch here. And now I know that if price is about to pull back, there's a decent probability that price might be reacting to this level again in the future. I have an idea about what might happen in the future, a leading indicator. And it doesn't get simpler and more robust than this horizontal line. I do not like to use sloping trend lines because those are always a little bit subjective to draw. And if those are broken, it's not really that perfect trigger that I'm looking for. And we found in our research and with our own trading that this horizontal line is way more robust and way more actionable for our trading setups than sloping trend lines. And you see prices pulling back. This line clusters very nicely here with a 61.8% retracement, and we can look and see if we find a cluster. That was the swing point high. Let's go to the previous swing point high, to the same swing point low. And we start to see the 50% retracement here. Not a perfect cluster, but again, in close proximity. So all this area here. Does price have to stop here and return? No, absolutely not. Price can do anything. Price can just blast through and that's it. But again, this pullback, that this might be a potential target. I knew this when I thought that this might be the swing point low. And here on this 1 minute chart, you've seen it now happen in real time. You start to see that this candle might be forming a little bit type of bearish right now, but it's still printing. We don't know. How could this be traded if I thought that this would be a beautiful downtrend and I would be speculating for trend continuation? I could be waiting here with a sell limit order. I can put this sell limit order in when price is still trading here in those levels. I think price might be hitting or shooting for this level. So I'm waiting there patiently, just like a sniper, waiting until I have my target, and then I want to sell this market at this limit price here. Where would be my stop loss? My stop loss would go just above the 100% retracement. So my stop loss would be sitting just here above the swing point high. Now, obviously, I would have now been triggered into the trade. Currently, I would be losing money. My stop loss would be sitting there. And the whole position sizing that I would have done here would have been in such a way that if this trade completely goes bad, and I will be stopped out right here and there, I will have lost 1% of my account. So if I'm trading a $10,000 account, I'm willing to risk $100. 1% of $10,000 is $100. So my position sizing would have been that, well, the question would have to be answered, how many lots, how many contracts may I trade in this move, that if I'm triggered in here and stopped out there, that this loss would just cost me $100, 1% of my account. That's the position sizing. Another way that this could potentially be traded would be could wait for the pullback to occur. I could wait for this small bearish candle setting up here. And let's make it larger. This small bearish candle to set up. And then my entry could have been another one, because now I've waited for price to come back, and so I would be waiting with a stop sell order just below the low of this candle. So price would now have just had to start to pull back below this level. It would have needed to trigger me into that trade. I do not want to sell for the most money that I can get, but I want to sell only if I see that price has started to push lower once again. And where would my stop loss in that case be? Well, my stop loss could then just go above the high of this candle. And this means this move higher here on the next 1 minute candle would have already invalidated my trade setup, and I would be out of the market once again. No trade, no loss. The setup is gone at that stage. Different ways to trade that move. Or you could have said here at that stage, well, I think this move might be over. Let's just enter here with a stop buy above the high of this candle. My stop loss would be going below the low of this candle, and I would be shooting here for a pullback. I would not have considered that trade at that stage because this candle is rather large and I'm shooting for a 1-to-1 reward to risk ratio, and the target level that I have identified is less than 1 time that distance here. Guys, this was quite a lot now in a short period of time. Just let me know. Is this fine the way it is? Are you terribly confused? Should I elaborate on some other concepts or ideas or explain things more? I'm running that session for you, so please don't be shy, let me know. And now reading the question from Lorenzo. So the 38.250 signify how likely the market is to retrace in percent. Oh, not sure if we can think about likelihood here. It's more how much of the distance will price have pulled back. So if we're, and let's get rid of those lines here. And zoom out a little bit. So, and forget about the higher order here. So let's look at the 38.2% retracement. This is not a probability, 38.2% probability. This just means the distance from this high to this low. At that point, when price will have pulled back all this way, that 38.2% of this move has been eroded. It's gone. Still 61.8% of this move still remain. Once again, the golden ratio here at play. 61 still are good, 38.2 have been gone. 50% pullback, why not a Fib pullback in itself? Obviously, people will pay attention. Wait, of this move down, 50% are already gone, so people will pay attention. And why does all this technical analysis stuff work at all? Because it's people acting in the markets. People pay attention to those levels. It's not that a certain price level, 1.0 in the US dollar against the Swiss franc, for example, has some kind of magical components or attributes. It's not that 3,000 points or 2,800 points in the S&P 500 are tremendously important. And there's a law in nature that 2,800, sorry, is absolutely significant. No, people pay attention to that level. Let's have a look at the market here. Where is the market? Price had a hard time to establish itself above this 2,800 level here in the S&P 500. You started to see the price started to fall apart. You started to see that we had divergence setting up here as price briefly tried to make a new high here beyond 2,800. Sure enough, price dropped down. How deep did price drop down? Swing point low to swing point high. And we start to see this was a pullback here to 61.8, a little bit beyond. Now another try is on its way to shoot for price to establish itself beyond 2,800. Will it happen? I don't know. We've seen a loss of momentum here, divergence setting up. So currently, yes, today's price action is strong. I don't know. Overall picture, price has a hard time to push beyond 2,800. Why? Because this 2,800 level is in the heads. It's in the heads of the traders. they pay attention to this and they say, I don't believe it will go beyond 2,800. And this is why they will start to initiate their short positions just at 2,799 and try to drive prices lower. It's just people reacting to this. It's not that this number is magical by any means. People pay attention to that. For the very same reason, if price drop beyond 50, drop to 50%, half of that move is already gone. So maybe, yeah, let's pay close attention here. 61.8%. People look at those levels. This is why those levels become significant. If you want to call it a self-fulfilling prophecy, yeah, sure enough, why not? The question is, does it help me making educated guesses just to avoid the word predictions? Yes, it helps me to make educated guesses. And this is what I'm looking for. By the way, this is not something that I would have considered to trade at that stage. Why? Because I know that this mental barrier of 2,800 is just sitting here. Price had a hard time to establish it there before. And again here, horizontal line of support resistance. I want my trades to have enough place to roam freely. I do not want to initiate a position and then just see that price accelerates just in order to hit that brick wall just in front of me. I want to see that price has enough potential to give me at least a 2-to-1 or 3-to-1 reward to risk ratio on my trades. Will I be shooting for those targets? Doesn't have to be that way, but at least the potential should be there. So you've seen that this works like a charm, not always, but a little bit more often than not. On the daily chart, we had a look at the US dollar Swiss franc on the 1 minute chart. Let's have a look, another example here at the US dollar against the Turkish lira. The style always remains the same, guys. This move here, Turkey, lots of political turmoil and situations. I don't want to comment on that too much, but at that stage, I started to initiate a short position in this market. Usually I'm a trend following trader, but here it was so obvious that price was overextended. What is overextended? You see, price is always returning to its moving averages. Remember, price never is able to move in one direction all the time. It's always this cycle. And here at those levels, price has moved away from those levels of equilibrium, price equilibrium, so far that it was clear that there has to be some kind of snapback. Well, what is the potential target for that snapback? One way, I use my moving averages here. Another way, I'm using my Fib retracements. I'm going from this swing point low. Sorry, guys. I'm going from this swing point low to this swing point high. Yeah, guess what? The pullback took us almost perfectly here to the 61.8% retracement level. Beautiful, beautiful. Doesn't get much better than that. So initiate a short position and speculate the price might be pulling back. Do I want to be greedy? Do I want to see the 61.8? No. Depending on where I got in, where I got my stop loss. Let's just assume that was the candle. My stop loss could, for example, have been just here above the high. If price pushes higher and makes the new high, I'm wrong. I want to be out. No hoping, no praying. There shouldn't be hoping and praying when it comes to trading. Trading should be boring and repeatable. Stop loss location. My entry could have been just below the close of this candle. So that's my risk. And now just see roughly, all right, this is 1 times the risk, about 2 times the risk, about 3 times the risk, about 4 times the risk. So with this entry and that stop loss location, this potential target that is now not confirmed but starts to cluster somewhat by both the Fib retracement and the moving average buy zone, all this together could give me here a potential 4-to-1 trade. How do we make money in the market? We want to win more often than we will lose, and we want to win bigger. And making $400 on that trade for a potential risk of $100, this definitely more than satisfies this condition of winning bigger than having to pay the losses. How do you find the moving averages is a question. I always use the same ones. It's always for me the 10, 20, 50, and 200 period moving average. And you guys decide what you like best. You decide if you want to use a simple moving average or if you want to use an exponential moving average. Coming back to the Hull moving average, I'm not sure that Hull actually would fit our criteria because we want it to be lagging, because we want it to be used to find those price equilibrium levels, to spot this overextension. And so if the moving average catches up too fast, I feel that this would take away from this price equilibrium identification usability that we use those moving averages for. It's the same settings on all time frames, on all markets. It doesn't make sense for me to have a setup that only works for gold but completely falls apart with oil. People make those markets. People act in those markets. And I don't see why I should behave completely differently in one market compared to another one. If I'm myself, I will be myself in oil, in gold, in Forex, in treasuries, in indices, in equities. It doesn't matter. I will be trading the same way. Therefore, people will behave the same way in different markets. So one size fits all, 10, 20, 50, 200. I do not care about the crosses. I want to see that price is pushing higher. And when price started to pull back here at those price levels, decent probability that price might be going for another new swing point high. So it's not this market has to drop all the way. No, this has been an overextension. This overextension has been fixed at that stage. I used my Fib retracements to help me to identify where price might be pulling back to. And then the major direction of the trend still is an uptrend. This pretty much changed. No, it didn't change here, because here we are still seeing a higher low. We haven't seen this higher high yet. At the very moment we started to pull back here, at that stage, price dropped below this low that had been established here. And then clearly at that stage, latest here, that uptrend was gone for good. Now it's a downtrend. Now I'm looking for potential short trading opportunities in this market. Let's start to zoom in here a little bit. Let's have a look at the 4-hour chart. Again, this swing point high, this swing point low to this swing point low. Yeah, this is pretty much a 100% pullback. It's about that the market here is about to shift to a downtrend. Let's just see from this swing point high, low to this swing point high. It's currently a pullback here to the 50% retracement. Question is, do you consider that to be a swing point low? Or do you think, no, that's still a sideways moves in price? That's a clear defined swing point low, and that's a swing point high. What is the correct answer here? There is no correct answer. But if you consider that to be a swing point low, you should always consider it to be a swing point low. You have to be consistent with your analysis. And this is where trading becomes a little bit more difficult, because you have to aim for consistency. A good enough for me today should never be not good enough for me tomorrow. And by the way, I was struggling, or I had been struggling for a long time, always asking myself that, is it good enough? Is this a swing point low? Is it good enough to form a swing point low? At one stage, I realized if I have to ask myself, is it good enough? I know the answer, it isn't. I always want to trade only the best and cleanest chart structures and chart setups. And for that reason, every time I ask myself, does it still qualify? Is it good enough? No, it doesn't. Move on to the next one. You don't have to be super precise here to realize if that's the low or that's the low. The big question is it a low at all or not? That the charts that I intend to trade must be beautiful. Everything must be perfect, and they must just scream at me, Philip, I'm the perfect trade. Please trade me. And I will start to look for that grain of salt, for that one thing that just doesn't make sense. And I really start to push it. And if I don't find that grain of salt, then this is when I want to take my trade. You only want to take those perfect trades, those perfect setups. Just looking here at the Aussie against the Kiwi. Daily chart, obviously, what is the trend? Just looking at the moving averages, I know that it's a downtrend. I can start to see that price is just about broken out of a level here. And if we have a look here at our 30-minute chart, we can start to see that there was this level established there, and once price started to break below this level, potential breakout trade occurring there. What was the target for a pullback here? This swing point high, sorry guys, this swing point high to this swing point low. And guess what? All this is very close next to each other. The 61.8 is where price has pulled back, but obviously this trend hasn't been well established yet. We see a lot of weak momentum here on this breakout. What would have kept me out of this breakout at that trade and at that point in time is that I had seen prices about to make a new lower low. However, MACD was diverging, as was RSI. Early warning sign keeps me out of that trade. Joey is saying here, I asked myself the same question, but then I fear that fear may be holding me back. Good point here. Personally, I feel, let's talk about the major components here about having a trading strategy. The first thing is you want to have your setups. That's the boring part. We talked about that a little bit today, but this is, you can get that down. The second part is you want to have your risk management in place. And risk management just is, there's my entry, there's my stop loss, and for that reason, my position size must not be larger than, because otherwise I would be risking more than 1%, and my trades, the risk exposure of those trades would no longer be comparable. Risk management keeps us in the game. It's absolutely crucial. But the major part that determines if we make it as traders or not is trading psychology. And when you talk here about the fear, that fear might be holding you back, that's absolutely real. That's absolutely, it's good that you've identified that. Now that you know and are aware that your emotions play a role there, this is something you can focus on, something that you can work with. I found for my trading that in the beginning, it was crucial for me to trade small. Let's just assume I had an account of, let's say, $25,000. I wouldn't fund my account with $25,000. I would just put $5,000 in my account. And then I would start to trade, risking 1%. All right, if this trade doesn't work out, I'm losing $50. Is losing $50 fun? Absolutely not. But ultimately, I couldn't care less. Those $50 gone, who cares? And this is how I still had this emotional exposure of trading real money without letting fear get into my way. Because obviously the losses were so small, I just don't care. And this is how I established enough confidence in myself to actually increase my trade size. I moved from 5,000 to 7,500. Never ever jump from 5,000 to 25,000. No, you want to increase it slowly, and you want to see that you stay consistent with your with the performance and the KPIs that you get from your trading strategy and your trades. And this is how you slowly grow your account. And at some stage, you realize, wait, I'm trading the full account. It doesn't hurt me because I know I can do it. I've seen it in the past with my small account. And the statistics are all there, and all this is working out. Trading psychology is a huge part. But so much just here for a short side note. Sorry for being sidetracked. All right, guys, just looking at the watch, we have about 5 more minutes left. Any specific questions here? All right, we had this one question before about Fib extensions. And let's just try to see here for one. All right, so let's go to my tools. Sorry, insert Fibonacci Fib expansion. If this is my swing point move here, I go from this swing point high to this swing point low. Sorry, guys. Come on. All right, so once again, insert Fibonacci Fib expansion. Sorry, something's wrong with my mouse. You see nothing because it's yellow, and it's ugly when it's yellow. Let's make it black here for a moment. And let's make it larger. Yeah. We want to go to the levels and do it here. All right. The basic idea here is that I go from my swing point high to my swing point low, just as before. But now the idea is, all right, if this is the move and the pullback is on its way, and I think the pullback might have finished, then I'm going to pick this third point and put it there. And now I have this idea that the move that follows might again adhere to some kind of specific ratios. That move might be, for example, just be 38.2% of this move, or it might be 50% or 61%, or it might be another one that I like to use very frequently is, for example, 27%. And this is where those Fib expansions here help us. So you can see from this swing point high to this swing point low and this pullback, the move to this level here, again, it works perfectly, 61.8%. So from here to there is 61.8% of the distance that we saw here. This is the idea here, that once again, you want to stack those things even further. You want to use not only this one, but also from the higher order time frame, just like we did with the Fib retracements. Vincenzo, this was rather short here, but the idea here is really, what is the move? And now I want to project certain ratios of this move based on the next swing point to follow. So that's the move. This is the next swing point, and we take it from there. The basic idea is always the same. Can I identify something? It helps me to identify a potential target in the future. And now I want to see if this starts to cluster with horizontal lines of support and resistance, with pivot points, for example, with moving averages in any way, kind of form or shape, with Fib retracements from previous moves. I want to see probabilities stacking. I want to see many things coming together and pointing in certain directions. All right, so guys, any more questions here? I think we have time for about maybe one more. But I think we are good, so let's quickly head back here to our slides. Yeah, why consider ATFX to be your broker? First of all, trading is a business. You want to have a good, solid business partner. And especially with finance, thanks to official authorities, I don't want to bring up the European Union in that context here, there are regulations for doing business as a broker. And ATFX, of course, completely complies to those regulations. You see the registration number here with the British FCA, Financial Conduct Authority. A major part here is, for example, saturation of funds. You want to have your funds in your own account, and ATFX shouldn't be able to access those funds, all those things. It's pretty common business practice. However, not all people, all companies play by the rules. You can be sure that ATFX is a well-established and well-recognized business partner when it comes to your trading needs. You have seen me here today working on the MetaTrader 4 platform, one of the most common platforms for trading the markets. Also good automation opportunities there. Finding the perfect trading package, finding the perfect trading platform, I feel this is always an eternal struggle, always going on. Some people swear by those platforms, others, I always try to look and find the perfect one for me. You have to find something that works for you there. Bespoke customer service and trade support for client trading needs 24/5. So as long as the market's open, especially nice, obviously, to trade those markets. If you have a 9-to-5 job, for example, Forex, the market's open Sunday evening, our time, when the market's open in Asia, Monday morning, and the markets close Friday evening in the United States, in between continuous trading for Forex and even for some of the commodities. And all the time when the markets are open, you have dedicated customer support available here. And the effort that ATFX puts into providing you guys with the best trading trading experience possible also shows here winner online personal wealth awards 2018. Have a look at the homepage and see what other awards ATFX has won in the past. Very easy to be in touch with ATFX in case you do have further questions. You see here email addresses and phone numbers. Give those good guys a call. Located not somewhere in Malta or some other kind of speculative place, let's put it that way. No, directly in London, United Kingdom. It doesn't get more transparent and precise than that. Guys, if you happen to have any further questions, more than happy to answer those questions right now. And if you don't have any questions, then the only thing left for me to do is thank you very much for tuning in. I hope you liked today's session. Please, there's a survey coming up. And if you liked the session, obviously I like to hear that we did well. However, if you didn't like the session, if you expected something else, please let us know. We're running those sessions for you. We want you guys to learn something, and we want to give you guys the experience that you came here for. So by all means, give us feedback. That's the only way how we can improve those sessions for you. Joey, Michael, thank you very much. Perfect. Thank you very much, everybody. Really appreciate the feedback here. Barbara, please be in touch with ATFX. They can help you there. Usually it's required to start with very little to get started there funding your account. Guys, once again, thank you very much for tuning in. Looking forward to our next webinars here at ATFX. And now to all of you, have a very nice evening. Happy trading over those next few days and take care. Catch you next time. Thanks again and bye-bye.